Welcome to Behind the Ticker. I'm Brad Roth, Chief Investment Officer of Thor Financial Technologies and Portfolio Manager of THLV, the Thor Low Volatility ETF. Behind the Ticker uncovers the inner workings of the ETF industry. We will interview portfolio managers and ETF service providers to dive deep into their work lives and their businesses. We will learn the inner workings of their strategies and what drives them as they continue to grow their company. Many of these individuals are entrepreneurs and will have unique and compelling insights to share as much goes on behind the ticker. Please note, nothing in this show is investment advice, and it is meant solely for educational and entertainment purposes only. Welcome to Behind the Ticker. Today we have on Jerry Parker. He is from Chesapeake, and we're here to talk about their ETF, ticker TFPN, the Blueprint Chesapeake Multi-Asset Trend ETF. As the name says, it is a trend-following product, trades multiple different markets, both long and short, does a wonderful job, in my observation, mitigating drawdown. I believe that this would be a very good addition and a bolt-on to help mitigate some overall volatility in the portfolio, as well as a product that can really go anywhere. So without further ado, please enjoy this episode with Mr. Jerry Parker. Hey, Jerry, welcome to the show.
Hey, Brad, thanks for having me. Good to be here.
Yeah, no, thanks for doing it. So can you give everybody a bit about your background, how you eventually started Chesapeake, and just give us how you got to where you are today?
Yes, I'll start in graduating from accounting and being an accountant in public accounting for a while, and really desperately wanting to not be in public accounting. Right shortly after college, I kind of figured that out. So I answered an ad in the Wall Street Journal to go to work for Richard Dennis, famous commodities trader in Chicago. The turtle story. Everyone's heard about that probably. And so December of 1983, I went to Chicago and was taught by Richard Dennis. It was 12 turtles at the time, and then we had a couple of weeks of a course and with Rich and Bill Eckhart, and then in January of 1984, we started trading with $1 million. He gave us $1 million. He gave us all this knowledge and everything we needed to know about trading futures, commodities, trend following. And then he gave us the money, and he was the perfect client because all we had to do to please him was to do what he taught us how to do, not even to make money really, because he said, if you make money the wrong way, I won't be very happy. So that program lasted about 4 years, and it was very successful. Most people were making probably 200% a year, 150% a year with large drawdowns and lots of risk. And then in February 1988, I started Chesapeake Capital. I would have loved to stay in Chicago, work for Rich for years and years, but they decided to end the turtle program, and that's how Chesapeake got started.
So it's funny, you and I share, we started 1 year, I did 1 year in public accounting and said that was enough for me. One tax season, and I threw my hands up.
Yeah, I was hell-bent on getting my certificate. That's kind of the goal I had. Okay, I did all this stuff. I passed the exam. I want to get my certificate. So after the few years that it takes to work under other accountants, you finally get your certificate. Then I was kind of out of there. And I was trying to find all kinds of jobs, stockbroker. And ironically, I interviewed for an assistant to a commodity trader in Richmond, Virginia, and I did not get the job. And just a few months later, I got the greatest job in the world, and one that no one should expect or deserve, to be handed a career, basically. And my resume is very short because I'm always dismayed by, send me your bio. And I'm like, oh God, I haven't done anything except trade futures and be a CTA for like almost my entire career, and Chesapeake. And I haven't really done much more than that because I've been so totally in love with trend following and focused on that. When I was in my 20s and learning about trend following in my spare time as an accountant, I just thought trend following was the greatest thing ever. I thought it from the first time I heard about it, and every day I've woken up since. I think I've just fallen in love over again And I think it's just the greatest thing ever. And I was just really happy that when I went to Chicago, I didn't really know, but I kind of thought maybe they were trend followers. And I was really happy that that was the case.
Yeah, so we're going to talk about that a little bit here in a little bit. But before we do, I'm sure trend following is not your only hobby. What are some of the things you like to do when you're not, trading and following the markets and doing stuff like this?
Well, believe it or not, I'm kind of older now, but for about 25 years, I've been really into working out and doing weightlifting, cardio, and I lost 65, 70 pounds in 1999. And so for some reason, I just woke up one day and I was like, okay, I'm going to, get my body straight, eat healthy, work out, having never done that before, having never been in shape before. And so it takes up a lot of my interest and time, diet and fitness. And then fishing. We live in Florida, and we've been fishing already a lot this year. And I like fishing quite a bit. Pickleball, that's the go-to for people my age, especially in Florida. My wife is a very good athlete, so that kind of kind of bums me out a little bit. She's so great at skiing, which I like to ski as well. But then she's a great tennis player. But pickleball levels the field quite a bit, so I enjoy pickleball.
Yeah, I heard the pickleball is definitely hot in the South. So, can we talk about Chesapeake as a whole? This isn't the ETF isn't the only thing you do. So, can you talk about all the things you're doing over at Chesapeake to help clients?
Well, we've kind of evolved into a ETF and mutual fund company. Yeah, so we have sort of given up on practicing classic trend following and earning an incentive fee. So we have sort of bit the bullet and just sort of said, okay, we're going to manage money for roughly 100 basis points. And so we have one of the oldest CTA trend following mutual funds out there that has been around for I think 12 years or so, and then an ETF that started almost a year ago. And so yeah, that's pretty much all we do, and it's all trend following. And the symbol is TFPN, and which stands for trend following plus nothing. So that's a little thing I came up with that I think is kind of funny, but that's sort of our total focus is bringing trend following to the masses and to people who love trend following. And there are a handful of people out there, a small percentage of people who really like it as much as we do.
Yeah, so let's talk about kind of systematic investing as a whole. And we'll also get into some trend following and some of the rules of the ETF. But what is it about systematic investing? And a lot of our listeners are financial advisors and RIAs. So what is it about that systematic process and about trend following that really makes it appealing for an investor and for an advisor?
Right. I definitely think systematic is a good way to start in talking about what we do. It is systematic. And it just so happens when we come up with rules and we test them on historical data, do a back test, the computer says, yeah, you should consider trend following. And but we have to be systematic first and foremost. We don't want to be doctrinaire or religious about one type of strategy unless it actually does work. So everyone kind of realizes that when you have something like investing, you have to come up with some rules in order to maintain some discipline and know what to do in all situations, and good situations and bad situations, tough situations. You want to have your rules, you want to stick by them. And the computer analysis and research basically says, look, if you apply these rules for the rest of your life, you may get performance that looks similar to history. Maybe that's what you're kind of hoping for. And you look at a lot of data, have a lot of sample size, and then you sort of put your faith in that and really try to fall in love with everything about the system. One of the things that Rich used to say is, traders should love their losses. And what he kind of meant was, you love everything about the systematic approach. It's losses, it's wins, it's win percentage, it gives back profits, too much profit sometimes, it makes a lot of profit sometimes. So you really want to embrace it and realize that objectivity and historical data researching and following a set of rules for the future is your best shot at taking money out of the market.
Yeah, and I couldn't agree more. I saw on your website you have a phrase, price is king. So can you elaborate on kind of how your process is using price to really generate and make investment decisions?
That's right. We only look at the price of the markets, and basically it will just using a sort of a trend following approach with moving averages or breakouts or something like that. Just by looking at the prices, you're able to come up with some entry and exit signals and sort of know what your positions ought to be. That's kind of the way we do it. And we try not to add in too many filters or bells and whistles that, number one, could keep us out of a trend. There's nothing worse than missing the trend. For a trend follower, 5 to 10% of the trades per year might be a big outlier trend. So number one, you just cannot miss those. You can't have a filter that filters you out of a trade. So you're always taking a lot of, all your trades are not A plus, they're C's and they're D's maybe, because you're really going to take every single trade that looks like it's in a trend. Thus your win percentage is going to be kind of low, and you're going to really have to rely upon those small losses. So before we do a trade, we have a predetermined loss that we're going to take on the trade. Then I think maybe the second most important thing is just hanging in with those winning trades and using the price and the signals that the prices give you, and that are going to sort of say, hey, the trend looks like it's ending. It looks like it's going the other way now. But our strategy is sort of really long term, and we try not to get out too quickly. We try to get as much out of these long term trends as possible, and not to pay too much attention to the give backs and the volatility. We would try to be shorter term. We would get out quicker if the computer told us that's what worked best. So we're really, the computer basically says, look, I'll tell you what works best, and that is hanging on to these trends a lot longer than you want to. It's going to be very uncomfortable. You've got to sit with some volatility. But if you want to pull the most out of the market that's possible, you're going to have some pain and suffering. And it makes sense to me, and I think to us, that that's kind of how the world works.
You bring up an interesting point, and I know that this is variable based on trend. It's variable based on volatility and market dynamics and how everything is working. But kind of on average, because you could set your moving averages a handful of different ways. What are your typical or ideal kind of holding periods? And again, it's definitely volatility dependent, price dependent. But what are you picking up super long-term cycles? Are we talking about a handful of years in some of these things, or a handful of months or weeks?
Our average holding period is about a year. We trade multiple systems, trend following systems, and some are shorter term than others. So, but they're all in that 9 to 12 month range. And some of these trends can last for multiple years, 2 or 3 years, that would pull the average up. Losing trades maybe wouldn't last as long because we're trying to keep the losses sort of optimal. We don't want them to be too small to where we're going to get whipsawed in and out. And obviously we don't want them to be too large. We trade about 400 different instruments. We could have 400 holdings at one time. So each trade, we like to call it, each bet we put on, the maximum loss is going to be really small, 10 to 15 basis points. So microscopic losses, but we have so many markets, and if we apply this, 5 to 10% of the trades will be a big mega outlier. We should have 20 to 40 big trades per year that will make up for trading each trade very small.
Oh, that's interesting. And we're going to unpack that in a little bit. So before we kind of dive deeper, I think it's better to talk high level about the specific ETF we're talking about, which is TFPN is the ticker, which is the Blueprint Chesapeake Multi-Asset Trend ETF. So can you kind of first at a high level explain what this ETF is trying to accomplish? And then we'll dig into the weeds a little bit.
Yes, it's trying to accomplish not so much a managed futures thing. It's really trying to accomplish, put trend following as its primary emphasis. We want to show what trend following can do. So with hundreds of markets like this, we feel like that this will show what trend following is all about. We can have keep more of a classic trend following approach where we really try to let the profits run and not be too interested in when the volatility kicks up in a trade like cocoa. I mean, the cocoa was out of sight and the volatility was crazy. A lot of CTAs are scaling back positions truly just based upon the volatility when cocoa is making all-time highs. So we're like, okay, we're going to have this one fund that sort of just says we're going to let it run, irrespective of the volatility. And trading so many markets, it sort of minimizes cocoa's impact, which is kind of bad in the sense that it would have been a great impact if we'd only traded 20 markets. But also, when you have those drawdown periods, it's really not anything that's going to upset you too much because it's just one out of hopefully 20 or 40 markets that are going to have this outlier trade.
So does the ETF go anywhere? Like what types of securities are generally going to be included inside of the the holdings file inside of this ETF?
Well, another saying we have is trend following everything. So we try to trade as many markets as we possibly can, and we have a lot of securities in there, a lot of stocks. Half the portfolio is stocks. So that right there, most CTAs don't trend follow their stocks. They don't trade single stocks. They trade indices. So we have all this diversification and all these different kind of stocks, long and short. Half the portfolio. The other half of the portfolio is made up of the currencies, the commodities, and the bond futures. And we have some bond ETFs, some of the exposure to the bond markets that you don't get in futures. We pick those up in ETFs like junk bonds, mortgage backs, TIPS, corporate, munis, things like that. So we're just searching the world over for securities, for futures, and trying to create this amazingly diverse portfolio. And so where some sort of the managed futures marketing is usually something like, please add us to your portfolio, a 5 or 10% allocation to your stock and bond portfolio for crisis alpha to mitigate the times where stocks are really bad and have a big sell-off. We're like, hey, there's a more direct approach. Let's trend follow the actual stocks and not rely upon the small allocation. I mean, our allocation will probably be small anyways, but we sort of say, let's get at this as quickly as possible and wrap around, equities themselves, stop losses, trailing stops, small losses, all the benefits and the risk management that trend following has, and pick up all this extra diversification that single stocks can give you that you don't get from indices. Like right now, every stock index future is long and all around the world. And but if you look at some individual stocks, there's a handful of shorts. We're certainly kind of in a up market, but still there's some shorts out there. So we really liked getting that diversification and being like the only CTA who really has a really diverse portfolio that includes trend following of the single stocks.
Well, in this particular ETF, you briefly mentioned shorting some stocks as well. So the portfolio is long short. Do you have any guardrails on kind of net long short exposure? I'm sure it doesn't get levered, but do you have any guardrails on your net long and or short exposures?
We set the portfolio up to have a max risk budget for the stocks, and the stocks can be long or short. We don't have a preference for either. It just depends upon which way the trend is going. And it's really great to come in and have longs and shorts, in a certain sector. Like right now, we have just mostly only shorts in the interest rates, and that's the way it has been for quite a while. And sometimes you get in these situations with the currencies as well, where you just long dollar and short all the currencies. And so that's kind of a bummer. Commodities can give you a little bit of diversification, longs and shorts. That's really got to be your first line of defense. In a sector, do I have some longs and shorts? Or am I going to be scrambling to have have this sector be mostly just one way, long or short, and have to scramble to reduce risk if the trends reverse. So I really like to come in and have longs and shorts. And commodities give you that, and stocks give it to you about as well as any other sector, especially recently, because even during this big run-up in equities, where we've had a lot of big trends in some of our long stocks, we still can find some stocks that are worth shorting, and they have their trends too. I think that people just get so focused on these indexes, and that's how they see the market. But if you look inside those indexes, you'll say, oh, okay, there's some stocks in here I want to go long, some I like to be flat, and some I would like to be short. And this is the benefit you get by not trading the indices and looking at each individual market. No CTA would ever say, well, I'm just going to trade the dollar index, or I'm just going to trade the Goldman Sachs commodity index or some commodity index. No, they would break that thing apart and see the benefits of the diversification, the sizing algorithm, and all of each individual market. And so we like to do that with the stocks as well.
Well, you walked me right into my next question, which is, let's talk about portfolio weighting. When running kind of a signal-based business, it can be hard that signal can sometimes be binary. So it could be hard to kind of do portfolio weighting. So how you mentioned correlation and a covariance process. Can you explain to the average advisor what that means and how you're going about weighting the holdings inside of this portfolio?
We like to set we have four major sectors. Maybe you can throw crypto in there as a fifth smaller sector. We have a few crypto stocks and blockchain stocks, and we trade the Bitcoin and Ethereum futures. But we like to set it up to where it's basically looking at these sectors and seeing how much diversification is within these sectors. So, like I said, with stocks, we feel like there's tremendous diversification here with thousands of stocks to choose from. And we can choose all kinds of stocks, all sorts of companies, maybe a lot of commodity-based commodities that are not on not where there's no futures to trade or no physical markets to trade. Pick up lithium and uranium and marijuana, things like that. So we're always trying to find stocks that have a sort of a commodity tilt to them. So we think that stocks alone, because there's so many to choose from, that's worth half the portfolio. And then we split up the rest evenly with the currencies, commodities, and interest rates. If there was thousands and thousands of commodities, that would be half the portfolio probably, or the same with the currencies. If you could get inside of that currency sector and really see some diversification, which is not always possible. We have had some good moves recently in the yen and the peso, but by and large, we just set the portfolio up to try to achieve maximum diversification from the get-go, from the very beginning. But then as we start trading, as we see the markets start to move around, the correlations will vary quite a bit. We trade gold and silver. You could argue that gold and silver are kind of the same thing, but sometimes it doesn't work that way. There's been times when silver kind of doubled or tripled in price and gold kind of sat there. Many times a few times heating oil has done the same thing, doubled in price due to something happening with the weather or freezing in New York, and crude kind of just sits there. So you don't want to be too concerned with what looks like a correlation because all of a sudden something can happen in these markets, and two markets that were once correlated look nothing alike any longer. And yet when the big trend is over in one of them, maybe they go back to being correlated again. So since our goal and our whole reason for existing is to hunt down these outlier trades and capture these things and allow a small percentage of the overall trades to make all the money and pay for all the small losing trades, we really don't want to take correlation too seriously because as we've seen historically, the markets are individual and they can do their own thing and have these idiosyncratic moves.
So the ETF in the portfolio does a fantastic job of drawdown mitigation. Your drawdown statistics are phenomenal. I would assume that has to do with the stop losses that you're kind of applying to all of these different positions. So can we talk about your stop losses a bit? Is it a static stop on each security? Is it variable dependent on the volatility of that particular security? Can you talk about how you're limiting that risk?
We limit the risk. Definitely part of that is with the stop losses. Like I said, when we put a trade on, we have a formula that tells us we want to treat all the trades the same, give them all the same amount of room, and lose the same amount potentially on each trade that we take. So we have a predetermined stop losses based upon the capital we have under management, the volatility in that particular market at entry, and so we just subtract something from that entry price, and then that tells us where to get out. We don't move that stop. It's just sits there the whole time, and then hopefully a trend begins and takes off, and then the trailing stop will move above that stop loss, and so the trailing stop will sort of take over. So just like trend following, the cliche is let profits run and take small losses. We are separating. We're treating the losing trades much different from the winning trades. We're going to be very conservative and very fearful of losing too much money on any one trade. But then if that trade becomes a profit, it's just hands off. We'll let that thing have lots of volatility, lots of drawdown, because we see all the time, big sell-offs and big drawdowns mean nothing sometimes because the market goes right back to all-time highs. So we see this in the data. We wouldn't do it if that's not what we saw in the data. We would love to trade shorter term. We're not in this for the pain and suffering. We just know that's kind of a part of the optimal strategy.
So when you get stopped out of a position, what is the ability to re-enter that position? Are you waiting for your next positive trend signal on? So will you just sit out of it and leave it on the bench until you get another long?
Oh no, if we get stopped out of a trade with our small loss, we will maybe go the opposite direction next time, wait for that entry signal, or have to get right back in. That's kind of what happens a lot is you take the small loss and you have to get back in in the same direction. It's kind of a bummer. But originally I didn't say it was a small loss. I corrected myself. I said it was a optimal loss. So we don't want it to be too small because that's going to make our win percentage really low. We're going to get chopped up. We're going to have to keep buying at new highs all the time. And so it's not going to work out very well. But the optimal loss, where you have that balance between keeping the losses under control, not letting them get crazy, and yet trying to maximize that win percentage and minimize the whipsawing nature of trend following.
So the portfolio is set up as active. Are you guys acting on new signals or new trends daily, or are you kind of assessing all of your signals and kind of on a more weekly or monthly rebalance schedule for kind of adding or deleting new positions?
We look at the markets daily and we download new data daily, put it in our computers, run the systems over the new data. But as I said, with averaging one trade per year per market, so we would have a tendency not to trade very often, even though we're ready to trade every day. We're acting like we're saying we will trade every day. We just usually don't have to, but not in every market. But with 400 markets, 4 different entries and exits systems, 1,600 now, you're inevitably going to get a trade, probably a small trade. So you're trading the max position for each market is small. Then when you cut that in quarters, it's even smaller. So we're always doing these small trades, almost every day we're just doing really small trades. But like I said, we're holding them for long periods of time, hopefully, as long as we can. We know that human beings don't like to hold on to things too long. They want to book a profit. It's a little pat on the back. It makes you feel better about yourself. The smallest profit, just a small little profit, maybe make your day. And so we know we want to stay away from what makes us feel good, what makes people feel good, because that's kind of the secret to the market. Put yourself in situations where your win percentage is less than 50%. You're willing to live with drawdowns. You're willing to live with volatility. Big profits turn into small profits. Big profits turn into losses even. So we really don't try to do anything to manipulate and to make ourselves feel better in the name of risk management. That's where I see a lot of people going wrong with silly rules, and if they just slap risk management on top of it, they think they can get away with it. But I feel like the big money is going to be made in letting those profits run and trying to and trading lots of markets. That's our kind of go-to. We can trade this strategy that really doesn't pay too much attention to volatility and drawdowns like most people do, but we trade so many different markets. It really one market's not going to help us that much or hurt us that much.
Right. So if you're sitting down with an investment advisor with an already diversified model portfolio, where are you putting TFPN? Is it kind of fits in the alt bucket, or would you argue that it's probably like a bolt on to large cap equity exposure? Where would you like it to sit ideally?
Oh, that's a tough question. Everybody answers this question to make the advisors feel better, but I think that we built it. You can put it wherever you want. You just understand what we're doing, understand why we think it's so great and how it is different. But we built it as the core holding. I don't want to have anything in my portfolio that doesn't have a stop loss and a trailing stop and can get me in gear with the right trend. Bonds were not a good option in 2022. You had to be short. And so I'm unrepentant on that. We need to be short stocks and bonds sometimes. So for me, I'm too conservative. I'm an accountant kind of at heart. And I'm not going to trade anything or have a portfolio that's not incredibly diversified, in gear with the trends, taking small losses all the time, habitually just taking small losses and letting those profits run and being in gear with the trend and not paying attention to what I think ought to happen in the markets, but looking at those price trends and using price as the only input. So we certainly built it as a core holding. But I'm sure people say, hey, I own a lot of TFPN. We love it. I don't pay any attention to what Jerry says about it being a core holding. It's 5 or 10%. I actually had someone this past weekend ask me, she was a young person. She said, help me build my portfolio. And she had 60-40, and I was like, oh, like 5% of TFPN. So I just can't make that decision for people. I sort of say, okay, even I'm going to be subject to what conventional wisdom. I don't believe it for myself, but I really believe that people have to make these decisions on their own. We have clients who love trend following. They understand. They think it's the greatest thing ever. Nothing could be better. But I guess for most of our clients, are just going to be people who have a small percentage allocated to alts.
Yeah. So Jerry, again, thank you for your time. I appreciate you being here. Before I let you go, where can people learn more about TFPN and Chesapeake and as well as yourself?
The best place to go is tfpnetf.com. That's all you need to know is right there with the proper disclosure. And Twitter, I'm on Twitter, I think RJPJR12. And podcasts like these. Thank you very much for having me.
Yeah, thanks again, Jerry. Appreciate you doing this.
Thanks, Brad.